Hey, everybody. Happy month end of September. Actually, not really for the equity market bulls out there or for all assets in general. Been a tough month, tough quarter. Someone we follow a lot, Andy Constant. You can find him on Twitter, most likely, or X, whatever it's called these days. Must follow. Really good insight into the swings of the markets, and I've learned a lot from Andy in the last 3 years since we've been friends and colleagues. I've been following his research and work, and he put out a sell signal a couple months back. Sell all assets. What does that mean? It basically is a point where, based on risk premiums, he felt that things in many asset classes, commodities, other things were fully valued. And it's rare, but in the last couple of years, he's put out a few of these signals. So let's have a look at the chart room at several asset classes and see what we learned this week. We've been talking in recent weeks and months about the rise in interest rates. We use the 30-year bond in our work for the discount factor that we look at in terms of cost of capital. And the reason is because the volatility of the 30-year bond is equal on average to the volatility of the S&P 500. So from a risk perspective, duration asset class, long bonds, is a good risk parity trade-off to broad equity markets in general. So going back to April, now we go back to this crosshatch here on the chart, and that was when we had a period of relatively stable rates. Though recall in March, we had the banking crisis, and that actually, as it was playing out here, put a little bit into the treasury markets, yields falling, prices rising. And so you see yields falling here in 30s, prices rising here in terms of the TLT ETF that represents the 20-year plus area of the market. But at this point here, we basically had the Fed programs announced and equity markets started to go again. And it was at this point where we started to see the rise in yields, but it wasn't till the quarterly refunding announcement here that yields really started to break to the upside, and very recently higher than the widest yields we saw in 2002 at the depths of the equity market sell-off back then. So when you look at where this peak in yields was in October of last year, and you look at this inflection point here, and then you say, well, where are equities today relative to this 100 basis point increase in the cost of capital over that period of time? Now, between September and October, you saw that move up significantly in a much shorter period of time than it did take now. It didn't get as extreme. So when we have the same lens, but in this case, we're looking at US 30 years and equities, you see that when 30-year yields peaked, it coincided with the bottoming of equities late last year. And all will know we got the bounce off the lows. We got the rally to start 2023. We got the sell-off on the banking crisis. And then again, here's the inflection point here that we highlighted on the chart, where we broke out through this resistance and started to trend higher. Market breadth started to improve, and overall the tone improved. Bond yields were rising, but they weren't breaking out. They weren't stressful yet. But in recent weeks, as we've got to higher and higher and higher yields, and ultimately higher than last year, that's really started to finally put some stress back in equities. So here's the Treasury funding announcement. Here's that shock that it gave to yields as they announced more coupons would be needed. That coincided with the peak of equities. And pretty much ever since, we've been giving this very, very cautionary message on equity markets. But right here is where Andy said, sell all assets. And so bond yields, bad. Stock market, bad. Okay, so let's look at the middle, early August, late July. And so this next chart here is the DBC broad commodity based ETF. Now, all should know that there's a heavy weighting here to energy markets. And so initially commodities come off their rally too, but very recently, the oil markets are moving higher. Everybody's crazy bullish about oil, not enough investment, yada, yada, yada. OPEC, supply curbs, and everything else. Here's a news story that hit the tape early this morning on Reuters. So I'm pretty active in the policy world of politics, hate politics, love policy, and pay a lot of attention to what's going on in the world. This headline hit the tape, this story, as you could see at 8:44 a.m. And basically, this is not new news. This has been working on in the background for an extensive period of time since Bahrain, under the Trump administration, signed on to the idea of accepting Israel, and Middle East dynamics changed quite a bit. This is a game changer for Middle East dynamics. Saudi defense pact tied to Israel deal passed, Palestinian demands put aside. We think as a negotiating tool that the Saudi Arabia had very specifically forced oil prices higher so that they would bring the US back to the table. China had approached Saudi Arabia a number of months ago, trying to broker a peace deal with Saudi Arabia and Iran. That's never going to happen, much like Iran's never going to have peace with Israel in the world. So they're fundamentally opposed to looking at the world differently and I guess sharing the same belief system, I guess, but one much more fundamentally radical in terms of religious ideology, and don't need to get into that. Anyways, my point being, I got sidetracked there. My point being that oil prices pushing up to $95 a barrel, wouldn't it be great as a Christmas present for that oil to be $75 a barrel? All may know that Saudi Aramco is looking to tranche out another piece of their asset there and ultimately take public everything and monetize that oil money while they still can, and buy up all real estate and other, cash flowing real assets. Again, while the getting's good in their sovereign wealth funds and whatever. So if you look at now, this ETF doesn't have the pre-market trading in it here, but basically you saw oil prices move. If we probably bring up oil price futures here, and we'll get the pre-market. So this hits the tape. You can see here 852, 845. You can see the story at 8:45. So as soon as that news story hit, oil prices started to bleed. And that dominated, to me, a lot that happened today. One of the things that it dominated was what was happening with the Canadian dollar at the time and other oil currencies. Again, 840, where are we in here, right? So you can see the Canadian dollar was stronger, the lower number here was stronger Canadian dollar, and then everything kind of sold off into the day with oil. So we think the OPEC is going to try to keep oil prices stronger until they do their secondary issue of Aramco. And then all of a sudden, you'll see as part of this deal, oil prices back to mid 70s for Christmas. Happy Joe Biden Christmas to Americans. So make no mistake, what happens politically does matter in markets. And when we saw that headline, we knew that it was going to be a game changer today. So final thing here, when we look at the real economy, everyone says how consumer's strong, everything's wonderful. This is XRT. This ETF represents an equal weight basket of U.S. retailers. And as we came out of the great financial crisis, there was a period here where interest rates were zero, always going to be zero, and the consumer stocks led and took off, first part of the rally there. But since we kind of hit this inflection point here, we zoom this out a bit, you can see for the better part of the last decade, the huge dislocation of COVID, that retail stocks on average have done nothing. And so how strong is the consumer, or how strong is the pricing power of consumer stocks? Nike reported an inventory controls and the stock jumped. But when you look at the components of this, and you look at what some of these stocks are doing, you can see these ugly patterns. And while Nike bounced today, this stock is probably heading back to $60, $70, and not surprising, like everything today, to see big reversal patterns even on the news there. So again, I question how healthy the consumer is here. I get everybody's working, but it does speak to the risk of a harder landing once those people who are working ultimately start losing their jobs in the higher for longer world. Anyways, the message remains caution, folks, on your equity portfolios here. We've certainly come off the boil from 4,600 on the S&P, testing into the 4,200s now. We talked about support likely in October around 4,200. And if we can't hold there, there's a lot more downside. So month of October, always interesting for equity markets. And if we start to see a bleed below 4,200, look out below. So I think some more volatility in front of us. Hate to be the bearer of bad news, but that's what's in my chart room this week. Have a good week, everybody.